Hello and welcome to the Retirement Planning Podcast, your trusted source for navigating the path to a secure retirement. Your host and guide on this journey towards financial peace of mind is Darren McComas. On this show, we'll delve into everything you need to know about retirement planning, from investment strategies and risk management to maximizing your Social Security benefits and crafting a resilient financial plan using the bucket plan financial process. Join me as we bring you insights from top financial experts, share stories of successful retirement journeys, and provide practical tips to help you build and preserve your wealth. Let's embark on this adventure together as we strive towards a future where retirement isn't just a dream, but a well-planned reality.
Hey everyone, welcome to the Retirement Planning Podcast. I'm your host, Darren McComas. I'm here with
Jason Fox.
Well, thanks for joining us today. Today is really part 2 of the One Big Beautiful Bill. We're going to do a deeper dive into capital gains tax opportunities that the One Big Beautiful Bill has opened up. We'll go through a couple examples today of how that can maybe apply to you and your situation. In part 1 of this that we filmed several weeks ago, that really dove into Roth conversion opportunities, and we'll kind of circle back to that at the end of today's episode as well. But man, it's episode 17. It's October. Yep. Year's flying by. It's almost a wrap, and we're excited to bring today's episode to you. So I think it really comes down to, Jason, these 7 words, right? Not all money is taxed the same. And what we mean by that is, right, there's 3 different funnels that people can be taxed on, and they're all taxed differently. The first one is that pre-tax funnel. That's your IRA, your 401k money, even your pensions. Distributions taken from that funnel are considered taxed as income. And then we have that tax advantage funnel, which we talked about last time. So walk us through that tax advantage funnel.
Yeah, that tax advantage funnel is where you get your Roth IRAs moved over, you get your cash value life insurance. And the advantage of this funnel is that once you move money into that funnel, whatever growth you get in that funnel is completely tax-free. So in the case of a Roth, you pull your money out of your IRA, you pay the taxes on that, you maybe convert it to a Roth, and then from that point forward, whatever growth you get, you never have to worry about RMDs or taxes or any of that stuff.
Right. So any distribution taken out of this funnel is typically 100% tax-free. And that's the funnel that we really talked about in part 1, episode 15. Today, we're really going to focus on this middle funnel, the post-tax funnel. These are contributions were made with after-tax dollars. So we're talking about brokerage accounts, bank accounts, even real estate would fall into this. You know, and as these assets appreciate over time and then you sell them and you realize that gain and you pull it out, you're not taxed on the whole account value. You're just taxed on the growth. And that can fall into 3 different tax levels. There's 0%, 15%, and then 20% on long-term capital gains. And we're talking about long-term being you held them more than 12 months before you sold them.
Yeah, that was an important detail to pick up on. If you buy an asset, say today, and then you sell it in 6 months, you're not going to get those long-term capital gain advantages. You do have to hold it for that year or longer.
Yeah, anything less than 12 months that you realize some gains on, you're taxed as short-term capital gains. Taxed as ordinary income on that money. And that could be in a much higher tax bracket depending on where you are. So for 2025, taxpayers can realize long-term capital gains at 0% federal tax if your income is below certain thresholds. For single people, you can make up to $48,350 in taxable income, and you'll fall in that 0% long-term capital gains bracket. Married, filing a joint return, you can make up to $96,700 of taxable income and have no capital gains taxes owed. So those are 2 very important numbers, and we'll come back to these in today's examples. So, you know, we love examples. We're math guys, right? We love working with real numbers. So let's go through a couple examples, and maybe you listening out there, some of these would apply to you. So we have a retired couple. And we're talking really about capital gain harvesting, right? Where we're going to harvest some of these gains. We've had really 3 good years in the market, 2023, 24, and this year's been a pretty positive year as well. So chances are you have some long-term capital gains in those brokerage accounts. So this retired couple, they have about 40,000 of Social Security income. Approximately 34,000 is taxable, right? Once we max out these long-term capital gain realization at that 0% bracket.
Right.
They have a pension of 30,000 and they have a gross income before deductions of around $64,000. Okay. Then we throw in the standard deduction, which this year is 31,500. That's the One Big Beautiful Bill enhanced version. Now that this couple is 65 and over, right, they get a couple extra bonus deductions. One is still in there from the Tax Cuts and Jobs Act. That's $1,600 each that they'll get. So combined, that's an extra $3,200. And then walk us through this new bonus deduction, the One Big Beautiful.
Yeah, a lot of people thought that, the One Big Beautiful Bill was going to completely eliminate taxes on Social Security. And while that did not come to fruition, what did happen is if you are 65 or older, you get an extra deduction of $6,000 per person. So if you're married, that's a total of $12,000 that you get to write off of your taxes and subsequently benefit from.
Yeah. On top of that additional standard deduction.
Correct.
That they left in there from the first, the Tax Cuts and Jobs Act that was passed the first time Trump was in office. So if we add all these up, the standard deduction, the additional deduction, and then the senior bonus, that's $46,700 that a married filing joint couple can realize in deductions this year.
Yeah, it sounds like an opportunity to me.
Yes. And it really, that extra $6,000 each is what today's focus is. That's an opportunity to really realize some capital gains and do it in this 0% tax bracket. All right, so for this couple, again, they have a gross income of around $64,000, and then they have those deductions of $46,700. Their taxable income, if you subtract those two numbers, is around $17,300. So it puts them in the very low tax brackets. And there's a real opportunity, right? If you remember, the capital gains threshold for 0% for a married couple is $96,700. Well, they're at $17,300. We have $79,400 of room to sell some stocks, take some winnings off the table, and still stay in that 0% tax. And who doesn't love 0% tax?
0% tax. And you're able to also step up your cost basis so that then you can take that money out. You don't necessarily have to pull it out of the market and spend it. If you want to, of course, you can do that. But you can also just reset your cost basis and benefit you as you move forward.
Yeah, wait over 30 days, right? And you can even repurchase those stocks. And like Jason said, reset your cost basis. But here, this couple, right, they realized $79,400 in long-term capital gains, paid no taxes on that. And now they have an annual tax savings of almost $12,000, right? Versus maybe waiting down the road where they realize this $79,400 at the 15% capital gains tax rate. I think the key thing we have to remember with the One Big Beautiful Bill is this extra $6,000 senior bonus deduction doesn't last forever. That is not set in stone. That is set to sunset at the end of 2028. So for us as advisors, right, we're having these discussions with our clients, like, don't waste 2025. There's a great opportunity here to realize some capital gains, take some winnings off the table. Maybe if we want to shift strategies or just lower risk or take some money for extra income,
right,
we have this beautiful opportunity. All right, let's look at example number 2. So we have a couple, early retiree, and now we're looking at strategic portfolio liquidation, right? We have a married couple, 65 years old, haven't turned on Social Security. They really have no earned income, right? They're not working anymore. They retired January 1st. They have a $600,000 stock portfolio. Their cost basis on that was $475,000, and they have $125,000 of capital gains, long-term capital gains. They need this $600,000 probably for income to live off of, maybe until Social Security or a pension kicks in, or they start pulling money out of their 401k or IRA.
Sure.
So, the $600,000 is going to be a key part to their
it's
retirement.
helping bridge the gap between their working years and their retirement years in the sense that they're pulling money out of their retirement accounts.
Yes. So again, their standard deduction, same as the first couple, 46,700. I'm not going to go through all those line item deductions, but it's exactly the same. They're 65 years old, married, filing joint, 46,700 in total deductions. So they have even bigger threshold in that 0% capital gains of 96,700 of taxable income. And the total room for 0% capital gains is actually, if you add those two numbers together, the standard deduction or their total deduction plus the threshold for 0% capital gains, they have over $143,000 of room. And they can actually liquidate that whole $600,000 portfolio and pay 0% capital gains tax.
Yeah, that's amazing. And when we run through this type of thing with clients, they're surprised at that, right? So we want you guys to be able to take advantage of this. If your advisor is talking to you about this, that's great. If he's not, then you should be contacting somebody who is going to have these conversations with you.
Yeah, and if I put this in context of people that we're meeting with, it's early on in that process, and we're trying to get a bucket plan put into place. They've been working their whole life. Mm-hmm. They really have no money in that soon bucket, that more conservative bucket that they're going to use for income maybe the next 5 to 10 years. And I could see this example couple here that applies, right? Oh. Everything is out there in that later bucket strategy.
Yeah.
Their 401ks, they have their brokerage account, all invested in stocks and more growth-oriented portfolios. Yep. And no real conservative soon bucket money. So here you are, you retire, you have no income. Now you have an opportunity maybe to take this stock-heavy brokerage account with lots of risk and move it into a more conservative portfolio and do it without triggering any capital gains tax whatsoever.
Yeah, and the ripple effects of benefits keep going. We talked about the cost basis before. That certainly applies. But then you're able to utilize that money in a way that you see fit without having to stress about, what am I going to have to pay in taxes if I do this or that? And the timing is so important, right? Because if you wait till that pension kicks in, or you wait till you're taking Social Security, you may not be able to take advantage of these tools.
Yeah, or you pull money out of that IRA or 401k, right. That all counts as taxable income now.
Yeah.
You may not be able to realize the sale of some of these stocks at 0%. So in this example we just went through, right, that's an $18,750 potential tax savings versus not having any plan and just kind of flying by the seat of your pants and one day just wanting to sell a bunch of stocks down the road. So, the one big beautiful bill has, again, opened up so many opportunities. And this just kind of summarizes that $600,000 in cash gives them a lot of flexibility.
Absolutely.
Whether they're using that for income in retirement, kind of out of that now and soon bucket strategy, it also could be used to do some future Roth conversions, right? Now you have $600,000 in cash to help pay for that taxes owed on converting 401k or IRA money into a Roth. And they can do that with cash that doesn't take a tax hit as well.
Well, right. And I think we talked about this a little bit when we were discussing Roth conversions, but if you're able to pay the taxes on your Roth conversions with cash in hand, it makes that Roth conversion that much more powerful because you have more soldiers on the battlefield and out there in that Roth account, right? And those are able to grow faster because you're starting with a larger sum of money.
Yeah, exactly. And, just let's walk through that example of what you just said, because that's super important. Let's say you're going to do a $100,000 Roth conversion from your 401k to a Roth IRA. Well, if you have cash, all 100,000 leaves your 401k. All 100,000 ends up in your Roth. You pay the tax bill out of, cash that's lying around in savings. Now you have 100,000 in that Roth to reinvest. And typically we advise most of our clients to be a little more aggressive in their Roth. Right. And that kind of ends up out in that later bucket strategy where we won't need to touch the Roth for 10 or more years. That's a powerful strategy versus, say, having taxes withheld. So let's say you have 20% withheld on that $100,000 conversion. Well, how much ends up in your Roth?
Right? 80,000.
Only 80,000.
Yeah.
And It's just going to take longer time in the market to eventually, if markets cooperate, recoup those taxes and get on the right side of things. So these are the strategies we love to talk clients through. And if your advisor is not even bringing these opportunities up to you, I think it's a great opportunity to maybe see what else is out there, have these conversations with your advisor, and take advantage of the One Big Beautiful Bill.
Yes.
Most of these provisions, like this extra senior deduction, they phase out.
Right.
There are income limits, and it does end in 2028. Don't miss out on 2025 if at all possible. This is one more year of minimizing your taxes for lifetime.
Yeah, absolutely. To your point, don't miss out on that, because we don't know what the future holds, right? We don't know what the next administration's going to do regarding taxes. We don't know a lot of different things about the future. But what we do know is that we have a huge national debt, and taxes don't typically go lower. They typically go higher. And so while taxes are lower for this period of time that we kind of have that locked in, it's a golden opportunity. And if you're sitting on your hands waiting, you're really doing yourself and your retirement a disservice.
Yeah. This is where it really pays to work with a fiduciary advisor who does financial planning and looks out over your lifetime tax burden and what are some opportunities that you could be doing now to be proactive, to put yourself in a much better position down the road. Heaven forbid if taxes do go up, having that Roth IRA is a powerful weapon to offset that. So we have an awesome One Big Beautiful guide that's available completely free, no obligation. If you would like a copy of this, it's about 9 or 10 pages long, but it's chock full of great ideas and information you should know about the One Big Beautiful Bill. You can go to our website, which is ewadvisors.com. Again, that's ewadvisors.com. And you can click on resources, and we have a section called guides, and you can download this completely free, or just email us at service@ewadvisors.com, and we'll make sure to send you a complimentary copy of the One Big Beautiful Act.
Absolutely.
And for those of us watching us on YouTube, don't forget to hit that like button and subscribe. We are trying to produce these about every 2 weeks, so you'll be alerted when the next new episode comes out. And don't be afraid to share our podcast with others that you think we can help. We need that algorithm to kick in and spread the word.
Yes.
There's a lot of great opportunities that unfortunately a lot of people are going to miss out on because they don't have this knowledge.
And of course, we're always available for consultations as well, and those are free of charge. But going back to the website, just click on there on the service email and send us an email. If you just you're like, hey, this all sounds interesting, I want to know more about it, we'd love to get on a Zoom call with you, or if you're here local, you can come into the office, and we'd love to have that conversation with you and kind of figure out where you're at and walk you through those steps.
Never hurts to have a free second opinion. Yep. And just see what you might be missing. Don't forget to hit us up on social media as well. We're on Instagram, Facebook, as well as Twitter or X, whatever it's called today, and LinkedIn. So hey, I hope you enjoyed this episode about the One Big Beautiful Bill and capital gains and some opportunities you have at your fingertips. Just, again, it pays to be proactive.
Yes.
So we look forward to seeing you on the next episode. Until then, you guys stay safe, and we'll see you soon.
See you next time.
Thank you for listening to the Retirement Planning Podcast. We hope we inspired you to make changes so you can live your best life. If you want to find out more about what we do, or you want to have a holistic wealth and health financial plan, please visit our website. Please subscribe to the podcast and share it widely with your friends and family. Financial planning and advisory services are offered through Prosperity Capital Advisors. PCA is an SEC-registered investment advisor with its principal place of business in the state of Ohio. Evergreen Wealth Advisors and PCA are separate non-affiliated entities. PCA does not provide tax or legal advice. Insurance offered through Evergreen Wealth Advisors are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information pertaining to the registration status of PCA. Please contact the firm or refer to the Investment Advisor Public Discourse website disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the discourse statement carefully before you invest or send money.